Welcome, ladies and gentlemen, from me, Guy Monson, to our regular 6-minute strategy summary and our last before the Christmas break. What an extraordinary year 2020 has been, I need hardly say. For us in the investment markets, almost every asset class has risen over the year, some to new records: global equities, government bonds, corporate bonds, credit, infrastructure, domestic real estate, even commodities. It's a testament really to the power of markets to look through the current crisis. After all, economies are experiencing their sharpest drawdown since the Second World War in many cases, and look to the liquidity and synchronized infrastructure and fiscal spend from governments into 2021. We'll look today at our policy conclusions from our recent IPC investment policy meeting and what they mean for asset allocation for you and for our clients in 2021. Let's begin on slide 2 by looking at two charts we followed regularly in this series. On the left, the total asset returns for a UK investor in sterling pounds. Look at that extraordinary rally up from the March lows in global equities in dark blue, 13% positive for the year to date. Set against the global stringency index, which measures the intensity of lockdowns, reaching levels almost equivalent to those we saw back in March and April earlier this year. Italy, France, the UK, Spain, all over 70% lockdowns. But asset markets have been able to be so positive is really down to the ability to look through to the economy in 2021. And you'll see in our new estimates from our Sarasin economists that we have upgraded growth in 2021 from 5.2 to 5.5%, a very strong vaccine-led recovery. We're making the assumption that around 75% of Western world populations are probably vaccinated by Q3 of next year, and that in Q1, most of the elderly and vulnerable are vaccinated, which allows economic activity to rebound as lockdowns are eased. Look at that extraordinary 9% growth rate in China, 4.1% rise in the US, all in all taking world economies back to somewhere where they were pre-crisis by Q3, Q4 2021. A little longer, I'm afraid, for the UK. So what are the challenges to this outlook, and can we afford to make that assumption of rebound? Well, first of all, we've got to get from where we are now to the vaccine world. That means that we've got to boost consumers' confidence numbers, which still remain weak, as you can see on the left-hand side, across the US in particular. Look at that present situation number. And secondly, we've got to manage a blip in inflation. Base effects, particularly from oil and energy prices, which have recovered strongly, could take inflation up to 2.5% in the US, similar numbers here in the UK, and then it falls back. That's a risk, of course, for consumer expenditure and potentially for bond markets. The good news surrounds China, where the numbers just get better and better. The economy now 3.2% larger than it was pre-crisis, driven by some extraordinary export numbers. On that top left-hand chart of slide 5, you can see exports up 21% for the year to date, taking the trade surplus as a whole up north of $75 billion. That's a record monthly number. That's driven by PPE equipment, protective equipment, work from home equipment in terms of computers and other technology that has caused a surge in the Chinese export machine. That means there's really no noticeable impact after Q3 because all of the losses in Q2 have been restored in a single quarter. The third point to highlight is that the noise of this recovery and the potential turnaround that we see does carry some risks for bond markets. You can see that those 30-year bond yields, which have been on a steady downward trend for more than a decade since the financial crisis, are beginning to rise. And that puts a question mark over the very sharply narrowing corporate bond spreads that we've seen as economic sentiment has improved over the last quarter. That's been a real benefit to our bond portfolios, but an area where we're becoming increasingly cautious. So let's balance up the good and the bad. The vaccine outlook's improved. Short-term equity risk premium, that's the yield, if you like, on equities versus bonds or cash, remains strong. Earnings and profits, I think, have the capacity to improve ahead of expectations in the year ahead. And certainly a divided Congress in the US will mean the central bank has to work harder. That means interest rates lower for longer. On the risks, the second wave is obviously intense. Valuations are somewhat stretched, and a pickup in bond market volatility, as I indicated, is a risk. So how have we balanced this up and how have we fed that into our long-term policy? Well, as we look into 2021, we're now clearly underweight bonds. We're worried about that government bond volatility, and we're worried that these corporate bond spreads, if you like, are a little too good to be true. By contrast, we're holding and even extending our overweight in equities, both in global equities, UK equities, where if that elusive Brexit deal does become possible, a huge flow of funds comes back to a very cheap market, and in emerging markets to reflect the power of the recovery in China-centric Asia. In alternatives, we remain overweight, but a slight twist, less in uncorrelated alternatives like gold, and more in infrastructure and renewables, which benefit from this huge fiscal spend. We're taking some of that bond market and just nudging up the cash position a little bit to give a little bit more flexibility and defensiveness. So I hope this sets the tone for a positive 2021, but one where we're realistic about the risks, those economic and in bond markets and interest rates, which could ripple through to some of today's high valuations. With that in mind, let me wish you all a very happy Christmas, a very happy New Year, and my wishes particularly out to Lord Frost and Michel Barnier. May they use the Christmas spirit to try and close this elusive Brexit deal once and for all. Thank you.